This lesson is part of the foundation of technical analysis, so it is beginner-friendly and designed to make chart reading clear from the start. Most traders look at a chart and only see candles moving up and down, but professional traders see structure, pressure, momentum, traps, and opportunity. If you want to become a better day trader, learning how to read charts is not optional. In this video, we will break down what trading charts really are, why they matter, and how line charts, bar charts, and candlestick charts reveal patterns, trends, and market behavior. We will also cover time frames, because the chart you choose can completely change your market interpretation. Even if you already study advanced concepts like ICT or SMC, this lesson is a useful refresher, because every advanced strategy starts with reading the chart correctly. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's get started. What exactly is a chart? A chart is essentially a visual representation of historical price data for a given asset. As you can see here on TradingView, the chart displays price changes over time, allowing traders to identify patterns and trends that may signal future market movements. On this screen, you will notice that the chart is divided into two main axes: the horizontal axis at the bottom, which represents time, and the vertical axis on the right, which represents price. These axes are fundamental to understanding how prices have evolved over specific periods. Now, as I move my cursor along the horizontal axis, you can see how the time changes, reflecting different trading sessions or periods. By moving up and down along the vertical axis, the corresponding price levels are highlighted. This setup is crucial in technical analysis because it allows us to see the big picture, how prices have fluctuated over time, and where potential opportunities or risks might appear. Next, let's dive into the types of charts. Here on TradingView, you have access to a variety of chart types, but we will focus on the three most common ones used in technical analysis: the line chart, the bar chart, and the candlestick chart. First, let's switch to the line chart. I will go ahead and select it from the chart type menu. As you can see, the line chart connects the closing prices of the asset over the selected time frame with a continuous line. It is simple and easy to interpret, which makes it a great tool for identifying the general direction of the market. However, notice how it only shows the closing prices. This means it does not provide detailed information about price movements within each period, such as the highs, lows, or opening prices. Next, I will switch to the bar chart. I will change the chart type, and now you can see a more detailed representation. Each bar corresponds to a specific period and shows four key pieces of information: the opening price, the closing price, the highest price, and the lowest price during that period. Notice how the left tick on each bar represents the opening price, the right tick represents the closing price, and the top and bottom of the bar indicate the highest and lowest prices, respectively. This type of chart is particularly useful when you need a deeper understanding of price volatility within each trading session. Finally, let's explore the candlestick chart, one of the most popular chart types among traders. I will switch to it now. Each candle on the chart represents the same four pieces of data as the bar chart: open, high, low, and close. But the information is presented in a more visually intuitive way. The body of the candle shows the difference between the opening and closing prices. If the closing price is higher than the opening price, the candle is usually colored green or white. If the closing price is lower, the candle is typically red or black. The thin lines above and below the body, known as wicks or shadows, represent the high and low prices during that period. As you watch the screen, you can see how these candles form patterns, which traders often use to anticipate future price movements. For example, a series of green candles might indicate an uptrend, while a sequence of red candles could signal a downtrend. The candlestick chart is especially powerful because it helps traders spot these trends and make informed decisions based on them. Now, moving on to timeframes. It is important to understand that timeframes refer to the time interval that each point, bar, or candle on a chart represents. In day trading, selecting the right time frame is crucial, as it directly impacts your analysis and decision-making process. Let's go through some of the most common time frames, which you can easily adjust here on TradingView. Later in the course, we will dedicate an entire chapter to market structure and how to combine different time frames to refine your entries in day trading, helping you maximize precision and profitability. Now, let's start with 1-minute charts, or M1. Each bar or candle here represents 1 minute of price activity. This time frame is particularly ideal for scalpers and traders who are looking to capitalize on quick, small price movements. As you can see, the chart updates rapidly, offering immediate feedback on very short-term market movements, which is perfect for those who prefer a high-frequency trading approach. Next, let's look at the 5-minute chart, or M5. I will switch to this time frame now. The 5-minute chart is one of the most popular among day traders because it provides a good balance between detail and context. It is highly effective for identifying short-term trends and intraday patterns. As you observe the chart, notice how the candles provide a more stable view of price action compared to the 1-minute chart, reducing some of the noise while still offering timely information for making quick decisions. Moving on to the 15-minute chart, or M15. I will adjust the chart to show this now. The 15-minute chart offers a broader view of price movements, allowing you to spot short-term trends with less noise. This time frame is particularly useful if you prefer to monitor the market over slightly longer intervals, capturing significant moves without being overwhelmed by the rapid fluctuations seen in shorter time frames. Next, let's explore the 1-hour chart, or H1. Switching to this time frame now, you can see that each bar or candle represents 1 hour of trading activity. This time frame is suitable for identifying more significant trends throughout the trading day. It provides a clear overview of the market's direction, making it useful for traders who prefer a less intensive and more deliberate approach to day trading. It is important to note that within a larger time frame candle, such as a 1-hour candle, many different movements can occur, even though the final price outcome may look the same. This is why we will dive deeper into candles and the psychology behind their formation later in the course, because this knowledge can significantly impact a trader's execution and performance. Now, let's look at the daily chart, or D1. Each bar here represents a full day of price action. Although daily charts are less commonly used by day traders, they can still be valuable for understanding the broader market trend before making intraday decisions. This time frame helps set the context, giving you a clearer picture of overall market sentiment. In addition to the time frames we have discussed, there is also the weekly chart, or W1, which I will switch to now. On a weekly chart, each bar or candle represents 1 full week of trading activity. This time frame is especially useful for understanding long-term trends and market sentiment, as it smooths out day-to-day fluctuations and provides a clearer view of the overall direction the market has been taking over weeks or even months. As you can see on the screen, the weekly chart consolidates all the price movements within a week into a single candle. This can be particularly valuable when you want to identify major support and resistance levels that are likely to be respected over longer periods. For day traders, while the weekly chart might not be used for daily trade execution, it is an excellent tool for setting a broader context. By analyzing weekly trends, you can align your day trading strategies with the longer-term market direction, helping ensure that your trades are not going against the prevailing trend. For example, if the weekly chart shows a strong upward trend, you might prefer to focus on long trades during your day trading sessions, as this would align with the overall market momentum. Conversely, if the weekly trend is downward, short trades might be more favorable. In summary, the weekly chart serves as a high-level roadmap that can help guide your day trading decisions, ensuring they are in harmony with the larger market trends. The relevance of these time frames in day trading is closely tied to each trader style and the nature of the market being traded. Shorter time frames such as the 1-minute or 5-minute charts, are ideal for traders who are looking to capitalize on quick, short-term opportunities. These traders thrive on the fast-paced nature of the market and prefer to make rapid decisions based on minute-to-minute price movements. On the other hand, slightly longer time frames, such as the 15-minute or 1-hour charts, are better suited for traders who prefer a more measured approach. These traders might want to observe and confirm clearer trends before entering a position, allowing for a more patient and strategic analysis of the market. The key is to choose a time frame that balances your need for detail with your need for broader context, ensuring that your trading decisions are informed by comprehensive and precise market analysis. In conclusion, choosing the right time frame is essential for navigating the market with precision. It helps you align your trades with prevailing trends, increasing your chances of making well-informed and profitable decisions. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.